Hello guys, let's continue with our class. So this is lesson 5 of financial reporting. So lesson 4 we did a question of April 2025 question 3. This question was for April 2025 question 3. I did not indicate, but this question we did was for April 2025 question 3. So someone told me to also use option B to find the investment in associate. So that's what I will do today. I will do this part before we proceed to the next part. Now for the option B, then you need to consider the parent shares of the net assets. And that one will be the 50, because this one is an associate, it will be equal to 50% of the net asset. Now this net asset is net asset. You need to know this. This parent share of the net asset of the joint is the 50% of the total value of the net asset in the balance sheet. No post or pre, just post or post retained earnings. That is in the balance sheet. So when we go to our balance sheet for jointry, it is 2300. I think you can see it is 2300. Uh-huh. Then we need to add the goodwill unimpaired. The goodwill unimpaired. So goodwill unimpaired is the normal goodwill. We need to compute that goodwill. URP on closing stock. Did we have URP on closing stock? Let us see if there was any information number 3 in that question. During the year ended at 1st December 2024, share perimeter sold goods to LIP. So there was no any URP in this case because there was no any transaction. So we need to compute the goodwill. Now let's compute goodwill. We shall use the equity method. So we start with the purchase consideration. So what was the purchase consideration? So that is in paragraph 2. At the start of the question, paragraph 2. So Poly Limited also acquired 50% of interest of Joint Limited when the purchase consideration was 10 million. So I'm going to put it in thousand. So I will put 10,000. Then we are supposed to less the net shares. We're supposed to less the net shares. So let us start with the first one, the ordinary share capital. Ordinary share capital is 15,000. So ordinary share capital is 15,000 times 0.5 because it is 50%. Share premium is 1,500. 1,500 times 0.5. Then we have the retained earnings, and we have the reserve, evaluation reserve. Now, retained earnings is at the date of acquisition. Retained earnings is at the date of acquisition. Now, the retained earnings at the date of acquisition was 2,500. 2,500 times 0.5. And then was there any revaluation of the joint? There was no, so this one is 0. There was no any revaluation for this one. So I think with that one, you can find the figures. Let's try and find the figures. So once you do it, you get this kind of an answer. So 50% of 2300 is 10,150. Goodwill impaired, you have calculated here. So purchase consideration rate the net asset, but remember retained earnings and revaluation is at the date of acquisition, but we do not have any revaluation for the joint venture. It was only for subsidiary. So when you find 500 as the goodwill and impaired, now in that case, you put the goodwill here because it's an impaired. Impaired means the opposite of the normal goodwill, which there was no any impaired goodwill in that case. So that will be 500. So you pick 10,150 plus 500, you get 10,650, which is the same as that one. Now, another thing I want to tell you, if there was any proposed dividend, from the joint venture, you need to incorporate it here. So we need to incorporate proposed dividend if there is. So I did not put that part, but there's a question I want to do where we shall incorporate the proposed dividend. Then you shall see how it affects this option. So in case where we have the proposed dividend, we need to put it here. That one is for the joint, for the associate actually, or the joint venture. The joint venture or the associate. It's using the same method, equity method. So this one is for associate or the joint venture. So that was the question that we did in our previous lesson. That was AP 2024. So today we are going to do another question. That one is for August 2024, question 2. August 2024, question 2. So August 2024, question 2. So August 2024, question 2. So make sure you have that past paper so that we can start. So let us focus on August 2024. August 2024. August 2024. Question number 2. So I'm going to read the question. The following information was extracted from the financial statement of Excel Limited, YEP Limited, and Z Limited for the year ended 30th June 2024. So we have the statements, we have the Excel, we have the YEP, and we have the Z. Then we go to the additional information direct. Now, the additional information number 1 is about the acquisition of the investment, where we have the number of shares acquired from YEP, and number of shares acquired from Z. Then you have the cost of investment for each. Then you have the retained earning as at the date of acquisition. Then Excel Limited also investment half of the 10% debentures of YEP. The fair value of the non-controlling interest was 240. So the NCI was measured at its fair value. That one is okay. The group used full goodwill method. That information is irrelevant because we know from the first information where there was fair value method. We know the fair value method. When the NCI is stated on fair value method, that is the full goodwill method. However, it does not amortize goodwill. Instead, goodwill is assessed for impairment annually. Impairment test for the year that is June revealed that none of the goodwill was impaired, so there was no any impairment of goodwill. So there was no any goodwill impaired, so the goodwill was unimpaired. Number 3 is about fair value measurement. So where we have the carrying amount for equipment and patents and the fair value. So, that is okay. And then the equipment and patent was depreciated or amortized using the straight-line method. That one is fine. During the year ended 30th June 2024, Excel Limited sold non-current asset to YEP for 360 million. X Limited marked up the equipment at a cost of 20% on cost. YEP included the equipment in its non-current assets and charged a depreciation rate of 20% on cost. So there is a transfer of asset from one company to another. So one will realize profit for fixed asset, the other one will not realize because they do not the assets is not meant for resale. So you need to eliminate that and realize profit. And then there was also sales of inventory. So during the year ended that is June 2024, YEP sold inventory to Excel for 30 million. YEP marked up those goods at a cost of at 25% on cost. So there was a markup of 25%. Then half of the goods were still in the stock of the Excel Limited. Then number 6, Excel Limited owned 200 million at the year end regard of transaction in note 5 above. Note 5, the one for 300 million. So there was an intercompany balance of 200. The books of Limited, however, showed that it owned only 160. Excel had sent a check to YEP on 24th June which was not received until 2nd July 2024, meaning there was a cash in transit somewhere in within. So the intergroup sales must be eliminated. So require number one, we are supposed to calculate the goodwill arising from the investment of YEP and Z. So remember, for YEP, we are going to use the full goodwill method, and for Z, you are going to use the partial method because it is either an associate or joint venture. Now, before we even do that goodwill, we need to assess, is YEP a subsidiary or a joint venture? Is Z an associate or joint venture or a subsidiary? Now, how do we do that one? Now we know Excel. So we know that Excel company acquired YEP Ltd and also acquired Z Ltd. So that those two companies were acquired. Now we do not have the percentage of acquisition, so we need to determine. Now we know that information number one, Excel acquired 16 million shares. So Excel acquired 16 million shares of YEP. Now that one is okay. Now let us see the total amount of share that was already that the Z had, so that we can determine the percentage of acquisition. Now let's go to a balance sheet. If you go to a balance sheet under the ordinary share capital, so we need to number of shares of Z. Number of shares is equal to the ordinary share capital over par value. So how much is that? So the ordinary share of Z, if you go to the additional information, is 200 million. 200 million divided by 20. That will be equal to around 10 million. 10 million shares. 10 million. It was 10 million. Z. Then we have Yang. You also have Yang. So the ordinary share capital for Yang, Yang is 600 million. 600 million divided by 20. That will be equal to 30 million shares. So let us see the percentage of acquisition. Let us see the percentage of acquisition. That is from information number one. That one is from the information number one. Let us start with Yang. Now Yang shares was 16 million divided by how much? How much was acquired from Yang? How much was acquired from Yang? Just a moment. Let me go back to Yang. Yang was supposed to be ordinary share capital. It's supposed to be 400,000. Yang is supposed to be 400,000. This one, the initial one. So this one is equal to 20. So meaning the total amount that was acquired. So the total amount was acquired was 16 million shares. So remember, 16 million shares was acquired. But how much was the total amount for Yang? The total amount for Yang was 20. So 16 out of 20 million was acquired. So how much is the percentage in terms of acquisition? So 16 divided by 20 times 100, which is 80%. Then for Z, 3 million shares was acquired. So how much was there initially? Initially, the total shares that were there was 10 million shares. So times 100, so we get the percentage of acquisition times 100, that is 30%. That is 30%, meaning that Yang is a subsidiary. Yang is a subsidiary, and Z is associate. It's an associate. So this one is YEP is 80%. This one is 30%. So meaning for subsidiary, we always have what we call the NCI, and controlling interest of 20%. So usually we'll have the non-controlling interest of 20%. So we are done with the information number 1. Let's go to information number. Still information number 1, investment in debenture. They told us that there was investment in debenture when acquiring the investment in debenture. When acquiring Z. When acquiring Z. Now, how much was the investment? So XL also investment 10% of YEP. So not of YEP. Who is YEP? Oh, of YEP. This is supposed to be YEP, not Yang. It's supposed to be YEP. So you need to up Yang. Supposed to be YEP. So let us see. They invest half of the debenture. So how much was the 10% debenture in our balance sheet? Now, if I go to our balance sheet for YEP, debenture, it is 400. You go to 10% debenture for YEP, it is 400. So they invested half. So half of the 400. So the investment, so they acquired YEP also using the debenture. So how much did they pay? Let's go to our purchase, look for purchase consideration. Now the purchase consideration about the cost of investment for YEP was 960. Remember, purchase consideration for YEP, purchase consideration was 960 plus the 200. How much is that? How much is that? So 960 plus 200. That is 1160. So that is what they incurred to acquire YEP. So that is what they incurred to acquire YEP. Yeah, that is okay. So let us continue. Let us continue. Now, but the total consideration, that's the total consideration for the 3 company. Now let's go to our balance sheet. Let's go to our balance sheet. If you go to our balance sheet for the investment part, remember for investment part, it is 1,400. Investment part supposed to be 1,400, but our figure is 1160. So meaning you need to include also, so for you to get this 1,400, you also need to include the purchase consideration of Z. So how much was the purchase consideration for Z? That is in information number 1. If you go to information number 1, the purchase consideration for Z was 240. So when you add 240, you shall get the same amount, this one, of 1140. I think you can confirm. So that's how you arrive at that investment in the balance sheet. So 1160 plus 240, which is 1400. But you are interested with this part, this one separate, and this one separate. So we need for YEP 960 plus 200, and we need the 240 for the Z, the associate company. That one being said, you can proceed to the next item, information number 2. Okay, before I go to information number 2, let us compute the goodwill. Anyway, before we go to the goodwill, because we need the revaluation, let's go to information number 2. The group uses full goodwill method. However, it does not amortize its goodwill. Instead, the goodwill is assessed for annual impairment. The impairment test for the year ended, that is June 2024, reveals that none of the goodwill is impaired. That one is correct. Information number 3, we have the revaluation. So we need to do the revaluation. Let's start with the equipment. evaluation. So here information number 3. This one was information number 1. So let's start with number 1, equipment. Equipment. Now remember, this is an asset. This is an item of PPE. So we take the fair value, we minus the carrying amount. So fair value 580 minus 500. So remember, for you to get the valuation, you get the fair value, you minus the carrying amount. So you have a valuation of 80. Then you can have depreciation under charge. 80. So divide by the useful life. The useful life is 10 years. So 10 years, that is 8 million. So we also have another item called patent. Patent. For patent, it is 320 minus 500 minus 300, which is 20. Then we have amortization. So a patent usually amortizes. So we need to calculate amortization. It is the revalued amount divided by the number of useful life, which is 10. With that one will give us 2 million. 2 million. So I think we are done with that one. Shall do the adjustment later. Information number 4. Information number 4 is talking about during the year ended, that is June, Excel Limited sold goods to YEP. Sold not goods, sold assets to YEP for 360 million. It was marked up with a markup of 20%. YEP Ltd included the equipment in its non-current assets and charge a depreciation at the rate of 20%. So we shall have a depreciation overcharge in that case. So number 4. So that is what we call the UPFA, intergroup sales of fixed asset. So intergroup sales, we take the, so to get the UPFA, you take margin, you multiply with transfer value. Transfer value. So in this case, our markup is 20%, meaning our margin, it will have a broad margin, so it will be 120 over 100 plus 20. Then you multiply with the transfer value, which is 360. So that will get the value of the UPFA. UPFA, that is 20 divided by 120 times 360. That is 60. Then depreciation overcharge. Overcharge to be 60% times the depreciation rate of 20%. So they say depreciation rate was 20%. That is 12 million. That is 12 million. So remember, this one was from, so the sale was from, so it was from Excel. You need to let us just, it was from Excel to YEP. That is from the parent to the subsidiary. Okay. Then we had something else. Intergroup sales. So we also have intergroup sales. Intergroup sales. Information number 5. During the year ended, that is June, YEP Limited sold inventory to Excel for 300 million. So YEP to Excel. So that's an upward stream. You can call it upward stream. So meaning the subsidiary sold goods to the parent. Now we need to compute the annualized profit on stock. Annualized profit on stock. You know, it's the profit margin. It's the profit margin, which is 25 over 125. So 25 over 125. We multiply with the goods that were in the store at the year end. So during the year ended 30th June 2024, YEP sold inventory to Exeter for 300 million. YEP marked up those goods on cost. Half of the goods were in store. So half of 300 were still in the store. So that is what we call the UPS. So that will be equal to 25 over 125 times a half times 300. That is 30. That is 30 million. That one being said, I think we can look for the intergroup sales. Sorry, not intergroup sales, intergroup owings. So you have an intergroup owing somewhere of how much? Intergroup owings. So intergroup owings of 200. So there was an intergroup owings of 200. So intergroup owings. Now let us analyze this question. So Excel owned YEP 200. So Excel had an owing of 200. He was supposed to pay YEP. So he was supposed to pay YEP. The books of Excel, however, showed he owned 160. So, but his books showed he owned 160, meaning he had paid 40. But this 40 was never received. So that 40 is good in transit. That 40 is good in transit. Good in transit. Now we shall do a working for that one later. For now, I think we can reach up to that point. So let us go to the question number 1. Goodwill arising from the acquisition of investment of YEP and Z. So let us start with goodwill for subsidiary. Subsidiary goodwill. So we have the NCI. Or let me just put full amount. So in 1,000. So we start with the purchase consideration. Purchase consideration. Now what about the purchase consideration? We have it here. The purchase consideration was 960 plus 20, which is I think it's supposed to be how much? Let me see. Purchase consideration. So purchase consideration. Let us go back to our question paradigm. Yeah, we have it. Just a moment. Just a moment. So purchase consideration is we shall consider only 960. The 200, this 200 was not during the time of acquisition. So we only consider the time of acquisition. That is 960. Then the fair value of the NCI. So the fair value of the NCI, this in information number 1, goes to 40. So that we can get the total figure. So we can get the total figure. I'm going to use this method because of time. You can also decide to use the cost of control account if you want the cost of control account, but I'm not going to use the cost of control account. Let us see the ordinary share capital. So ordinary share capital, I put full amount. Reason why? Because I'm combining the two. Since I'm combining the two, I'll use the full amount. So the ordinary share capital it is 400. 400. Share premium. Share premium is 200. Retained earning. So this is at acquisition date. So retained earning as the date of acquisition. So the retained earning as the date of acquisition was for YEP 300. Then we have the valuation also at the date of acquisition. That was how much? Did you calculate the valuation? Yes, we had the valuation here. After the date of acquisition, we have 80. We have it here 80 and 20. That is 100. So that is 80 plus 20. That is 100. Then you can get our goodwill. There was no impairment, so that one will be the goodwill direct because there was no impairment. So 1200 minus 400 minus 200 minus 300 minus 100. So the goodwill is 200. So the goodwill, in that case, I think it is supposed to be 200. You can also do the partial method for Z. So for the associate, so we have the purchase consideration. So purchase consideration for Z was 240. That is information number 1. Then you are supposed to less the net assets. So ordinary share capital, share premium, retained earnings. Then you have revaluation. This one is for at the acquisition. This one is at acquisition. So ordinary share capital. So ordinary share capital. This one we need to apportion. So let's go to Z. You go to Z. 200 times 30%. So this is supposed to be 200 times 30%. I think it is 60. Then share premium. The share premium is 100. 100 times 30%, which is 30. Retained earnings at the date of acquisition, that is information number 1. It was 200 times 30%, which is 60. There was no any revaluation for associate, so they only revalued the subsidiary, information number 3. It's only YEP that was revalued, but associate was never revalued. So 240 minus 60 minus 30 minus 60, that is 90. Now for this one, if you want to do it kando, it's okay. But when you do it separately, you need to apportion the net asset. For example, if you decide to open the cost of control account, for example, so we have the purchase consideration and 60. Then we come to ordinary share capital. So the parent is 80% times 400. You put the amount there. For share premium, 80% times 200. Retained earnings is 80% times 300. Then revaluation, it is 80% times 100. Then you get the balancing figure as goodwill. So that is if you decide to use this cost of control account. Then when you use the cost of control account, you need to do the cost of control account also for NCI. This one is for YEP. Also for NCI, start with the purchase consideration, it was 240. Then ordinary share capital, 20% times 400. Share premium, 20% times 200. If you decide to use this method, this is just by the way. 20% of 300. Then you have the revaluation surplus, which is 20% times 100. Now we shall get the same amount. So goodwill, getting to the NCI. We can try and see if it will balance. Let us try and see. So 400 times 0.8, then it's 320. 160 to 40. Then is 80. So balancing figure, so 960 minus 320 minus 160 minus 240 minus 80. Then we are getting 160 as the goodwill for the parent. 160. So meaning for the other one is supposed to be 40, so that it will get the 200 when we add the two. Let us see. So 0.400 times 0.2, 80. 200, 40, 300, 60, 100, 20. When you get the balancing figure, how much are you getting? Let us see. 240 minus 80 minus 40 minus 60 minus 20. I'm getting 40. So when you add 160 plus 140, you get this one. So 160 plus 40. Now if you decide to use the cost of control account, so then we call it the cost of control account. Cost of control account. This one, the two item. Now I'm not going to use that one. I'm going to stick with that one. So information number one, we are done. Information number one, we are done. Let us do information number two. Information number two, we are supposed to come up with a consolidated statement of the financial position. Consolidated statement of the financial position. So let us do the consolidated statement of the financial position. So let us do the PPE. So PPE, we take the one for parent and for subsidiary. So we go to the balance sheet. So you go to a balance sheet. PPE is 2100. 2100 plus 1500. We're supposed to add any revaluation that was there. So we had a revaluation of 100. That was 80 plus 20. Then you need to deduct depreciation under charge. So you need to deduct depreciation under charge. Depreciation under charge. How much was the depreciation under charge? Now, before even we look at the depreciation under charge, it was 8. Let's go to our equation back. Let's go back to our equation. Now, this depreciation charge was there in the year 2022 because the useful life. So, so immediate after acquisition, that is acquisition of YEP. We're talking about YEP. Immediately after acquisition, this was in the year 2022. So this depreciation charge was 2022. But we are now in 2024. So we have an accumulated depreciation for that. So we need to raise the accumulated depreciation. For how many years up to now? We are from 2022 up to 2024. That is 2 years. So that will be 8 times 2. So this depreciation under charge will be times 2. That will be equal to 16. So depreciation under charge, we need to consider it was for 2022. But remember, we are preparing the account for 2024. That is 2 years down the line. So that 8 million, it was for the last 2 years. So we need to account for those 2 years that that has been revalued up to date. That is okay. So that will be equal to 16. Then we need to less the annualized profit on fixed asset. Annualized profit on fixed asset. How much was that? Annualized profit on fixed asset. This one. It was 60. So we need to less 60. Then we need to add the depreciation overcharge. Depreciation overcharge. How much was that? So that one for for transfer of fixed asset, that was done within the year. That was in 2024. So we don't need to apportion. This one was for year 2024. So it will remain as 12. So it will remain as 12. So that will be the end of that part. Number 2, intangible asset. So we have an intangible asset in our statement. Let's go back to our intangible asset. 400 and 300. So we have 400 and 300. But we had amortization. We had a revaluation. First, let's start with the revaluation. So we had a revaluation of the patent, which was 20. But that revaluation of 20 was impaired by 2 million. But remember that one was at the date of acquisition, so we need to multiply by the 2 years that it has accumulated. So 2 million times 2 is supposed to be 4. So it has accumulated because it was there. So for revaluation, for equipment and patent was there at the date of acquisition. That was in the year 2022. So 2 years down the line. So we need to multiply by 2 years. Goodwill for YEP, that one we have computed it. So before we continue, let us do this one. 2100 plus 1500 plus 100 minus 16 minus 60 plus 12. That is 36. Then 400 plus 300 plus 20 minus 4. So that is 716. Then the goodwill for YEP ndio ile. Goodwill for YEP is goodwill for YEP is 200. That is correct. Goodwill is 200. Let me 2100 plus 1500 plus 100. Not 100. This is supposed to be 80. Reason why? Because the valuation for PPE, for patent 20, we have it here 20. So 80 and 20. So total valuation was 100, but 80 was for plant, and then 20 was for the patent. So patent is part of intangible asset. So I need to correct that one. Plus 80 minus 16 minus 60 plus 12. That is 3616. 16. Then we need to do working for investment in associate. We can do it, I think. That's why it does not have a lot of working. Investment in associate. So let us do the investment in associate. Investment in associate. We shall use the 2 methods. So let us use the investment in associate. I will use option A. I'm going to use option A. Investment in associate. So option A, we have the cost of investment. Cost of investment. How much is the cost of investment? That one is for associate, that is Z. It is to 40. To 40. Then goodwill and impaired. So we add goodwill and impaired. Goodwill and impaired. And it is 90. We have it there. Goodwill and impaired is 90. And then you can look at, you can try and look at URP, less the URP. There was no any URP. Unrealized profit on closing stock. Ama UPS. Unrealized profit on closing stock. There was no any. But remember, we need to add now dividend received. That one is from the proposed dividend. dividend received. So they shall receive 30% of the proposed dividend. So let's go to our balance sheet. Then we go to the current liabilities. Let's go to our balance sheet. Then we go to our current liabilities. We are the proposed dividend for Z. Out of the 100, they will receive 30%. So 100, that will be 30. So with that one, we can get the investment in associate. Investment in associate. You can get the investment in associate. Actually, I will use the wrong method. I've used the wrong method. This one was not supposed to add the goodwill. You're supposed to add the. You're supposed to add what we call the post-acquisition profit. Post-acquisition profit. The post-acquisition profit it will be 30%. It will be 30%. Let me do it here. 30% of the retained earnings at the beginning. So what are the retained earnings? Sorry, retained earnings at the end. That is for Z. So the retained earnings at the end. Retained earnings at the end is 500 minus the retained earning as the date of acquisition. So the retained earning as the date of acquisition was 200. 200. That will be 500 minus 200 times 0.3. That is 90. Now you can get the acquisition, so to 40 plus 90 plus 30. That is 360. So meaning our figure here is 360. You can also use the other method of the net asset. I don't know if it will accept, but let us try. Let's try the net asset. We say the parent net asset. Parent net asset. How much will be the parent net asset? It will be 30% of the total assets. So 30%. So total asset as per balance sheet. So let us go to balance sheet and add all the total assets. For equity, it is, I can see it is, can see it's giving us it is total 800. So in the balance sheet, not pre-acquisition. So remember in this case, when you use the other method for associate, when you take the parent net asset, it is in the balance sheet direct, no pre. This one will be equal to 240. And then we are supposed to deduct the goodwill and impaired. So we do not have goodwill and impaired. We had it. So goodwill and impaired. I think it was 90. We have it there. 90. Then now we add the dividend received because we no UPS. So no UPS. But you have added dividend received. Received, which is 30% times 100, which is 30. It will give the same answer of 360. That one is by the way. So we don't need to concentrate so much on that. So that one is the end of it. Let us go to the next item. The next item is inventory. So the next item is inventory. So we take the parent and then for the, so 700 plus 600. 700 plus 600. 700 plus 600. Then we need to raise the UPS. So the UPS and the net profit on stock. We did a working somewhere. That we have it here to starting. Good in transit, we had good in transit, we said it was 40. So good in transit, we said it was 40. It was never received. Trade receivables. So we add the trade receivables. 640 plus 340. 640 plus 340. Then we need to raise the owings. Now the owings, now remember it is for so one was owing another one. So X0 was supposed to pay the subsidiary. So supposed to pay how much? 200. But he had already sent a check of 40, meaning 160 was remaining. Where also we less the 40 because it was paid. So that 160 plus 40 becomes the total 200. So it was removed. Then we have the fair value. The fair value. The fair value asset is the 60 plus 260. There was no any other adjustment. 360 plus 260. Then cash, it was 200 and 100. There was no any other item. So we can get our total assets. So get our total assets. So 700 plus 600 minus 30. That one is 1270. Cash and deposit was 40. So 640 plus 340 minus 160 minus 40. 780. 360 plus 260. 620. Then the other one is 100. 620 and 100. Let us add them together. That's 616, 716, 200, 360, 1270, 40, 780, 620, and 300. I'm getting 7902. Total assets 7902. Now for premium, we take the one for the parent. For share, this one also we take for the parent. So we take it direct. Let's go and find for parent 1600. And then 400. This one requires a working. This one requires a working. Debenture, we need to add the two. So debenture 1200, 1200 plus 400. But remember, we need to deduct the amount that was invested. This one. So 200 was invested, so it will reduce this amount by 200. Deferred tax. Deferred tax, it's direct. 500 plus 200. 500 plus 200. There was no any adjustment for that. Payables. This one requires an adjustment of owings. 600 plus 700. But remember to raise the owings of 200. Current tax, there was no any working. Current tax, 500 plus 300 plus 300. Then proposed dividend, we need to add 200 plus 200, but we need to raise the proposed dividend. 200 for the parent, and then 200 for the. Then you raise the proposed dividend for the parent. That is 80% of this 200. This one. So they need to pay dividend from this amount of 200. Then you shall get your total value. Let us compute. Now 1200 plus 400 minus 200. That is 1400. This one is 700. 600 plus 700 minus 200. 1100. This one is 800. So 200 plus 200 minus 80 times 200 to 40. Your total equity and liability must be equal to 7902. So I think now we can open the retained earnings account. We can open the retained earnings account and the NCI. So retained earnings account. and the NCI account. So retained earnings account, the NCI. So retained earnings account. Then we have the NCI account. So we start with the NCI value. So we start with the fair value. So the fair value was 240 of the NCI here. Then post acquisition retained earning. Post acquisition retained earnings. Now it's supposed to be 20%. We multiply by, so the retained earnings at the beginning, retained earnings at the balance sheet, which is 700, minus the retained earnings as of the date of acquisition, which is 300. So how much? So 700 minus 300 times 0.2, 80. Then depreciation overcharge. 20%. So the share of the NCI is 20%. So depreciation overcharge was 12. We have it here of 12. This one is 24. And there also any other account which affect this account. Not 24, 2.4. 2.4. Then let's go to the other side, on this side. Now on this side, we can start with the depreciation under charge. Depreciation under charge. Now depreciation under charge, the share of the NCI is 20%. So what is the depreciation under charge? Remember we multiply by 2. So 8 times 2, that is 16. 16, which is equal to 3.2. Amortization, it was 20%. 20% for the NCI. But amortization was 2, but for the 2 years, 2 times 2, that is 4. So that will be equal to 0.8. Then UPS, if upward, UPS is supposed to be upward. So UPS is supposed to be upward. Let us confirm if it was upward, says. Yes, it was upward, says. YEP sold to Excel. So upward. So, but if it's from Excel to YEP, UPS will not be there. But because it was an upward, then 30% of that amount, not 30%, 20% of the share of the NCI, you multiply with the UPS, upward UPS, which is 30, that will be equal to 6. There was no any other account affecting this account, so we can balance. So there was no any other account which affected this account. So 240 plus 80 plus 2.4, that is 322.2, 322.4. 322.4. So you get the balancing figure 3.2, 0.8 plus 6. So 312.4. So that is NCI to statement of financial position. So NCI, the YABA 312.4. Now we are remaining with one item, that is the retained earnings. We can balance this account and then we see how much is supposed to be that also. 1600 plus 400 plus 312.4 plus 1400 plus 700 plus 1100 plus 800 plus 240. So 7902 minus answer. I'm supposed to get 1349.6. 1349.6 to balance this account. Something like that one. 13.9.6. So 13 supposed to get what? 1349. So let us do this one. Let us start with the balances. So balance for Excel. So balance down. This one is for Excel. So balance for Excel in our balance sheet. Is 1000. Where is it? Retained earnings. It is 800. It is 800. Then post acquisition profit. Post acquisition profit. So for post acquisition profit, we need to start with the one for YEP and then Z. So start for YEP, then Z. So that's supposed to be 80%. So it's supposed to be 30%. So 30% and that one. So for YEP, retained earnings at that date at the balance sheet is 700. We have it here at 700 minus 300. So itakuwa ngapi? 700 minus 300 times 0.8. 320. Aya for Z. Now for Z, retained earnings is 500. The date of acquisition. In the date of acquisition, retained earnings at the date of acquisition was 200. That is the cost. So 500 minus 200 times 0.3. That is 90. Now let us check for depreciation. Overcharge. Depreciation overcharge. Overcharge. 80%. So 80% of 12. That will be 9.6. The range will be 9.6. So 80% will be 9.6. Then dividend received. In this case, we shall have because of the proposed dividend. Dividend received. So we have YEP and Z. So this one take 80%, the other one take 30% of the proposed dividend. Let us start with Yang. The proposed dividend for Yang. Proposed dividend for Yang is 200. The other one is 100 for Z. 80, and that there's no any other account there. So there is no any other account in that case. Now let us go to the upper part, the other side. Depreciation under charge. Depreciation under charge. Under charge. Now depreciation under charge is 80% of 16. 80% of 16, 12.8. So 80% of 16. So the opposite. Amortization. 80% of 4. 80% of 4. 3.2. And then we have UPS. UPS 80% of 30. 80% of 30. That will be equal to 24. That will be equal to 24. That will be equal to 24. Then there's one amount that we need to consider, that is the UPFA. But UPFA, we shall put it as a full amount. UPFA is supposed to be full amount. So this one, UPFA, another profit on fixed asset. This one you put full amount of 60. This one, UPFA of 60. It will also affect the tenant's account. That is all about it. So let's balance the account. So 800 plus 320 plus 90 plus 9.6 plus 80 plus 30. That is 1329.6. 1329.6. Now the retained earnings to statement of financial position. So minus 12.8, 3.2, 24, and 60. Have I done? Just a moment. So there is an error somewhere. This one, 80% of 200. This one is supposed to be 160. Supposed to be 160. Just a small error. So 800 plus 320 plus 90 plus 9.6 plus 160 plus 30. Supposed to be 1409.6 for 1409.6 1409.6. Now you can balance 12.8 3.2 24 plus 6. That is 1309. 1309.6. Why is it 1309 13? Let us confirm. 1309.6. So let us try to balance this account. So 1600 plus 400 plus 1309.6 12.4 plus 1400 plus 700 plus 1100 plus 800 plus 240. I'm getting 78. So where is the error? I'm getting 78 something. Oh, I know where the issue is. This one already they are already paid 40. So the already is supposed to be it's supposed to be 140. So they had already paid that amount. So it's supposed to be minus 140. So 600 plus 700 minus 140. That's supposed to be 1160. So I think when you add that this account, it's supposed to balance. So that's all about this question. That was the question for August 2024. Question 2 for the group account. So I hope everything is fine. I think we shall meet for another class, and then with another 2 classes, but that one will be later. Then we finish these consolidated statements. So make sure you are familiar with the balance sheet, because the next class that we will be doing, it will be about the income statement. So at the moment, do more question where we have balance sheets. Then once I'm done with the one for the income statement, then you can comfortably do it also. So that is all. That is all about this question. I don't think there is any other thing. So actually we have another problem as arisen. It's not balancing. This one is not supposed to be 140. It's supposed to be 160. So 600 plus 700 minus 160. 1140. It's supposed to be 160, not 140. I don't know where I got 140. It's supposed to be 140. It's supposed to be 160, sorry, not 140. So I think that one is balancing now. So once you add them to balance, so I want to wish you well when we meet next concerning group accounts, we shall specifically focus on the income statements. Goodbye.